It's kind of overwhelming when you see all these news stories and headlines about global markets and turmoil and wars, especially if you don't have a finance background. Most people overthink investing by chasing hot stocks and waiting for the perfect time. But the truth is, building wealth in your 30s doesn't have to be complicated. We've all been told the same thing: max out your 401k, buy index funds, and you'll be fine. But if you're like me, that advice probably leaves you wondering why the number in your account grows so slowly and why life still feels so expensive. Most people don't need to learn about more investing options. What they need is a simpler system, one that actually helps you cover the costs of life in your 30s, like rent, taxes, maybe having kids, or buying a home. I'm currently 31 years old, I live in New York City, and I only really started focusing on this in the past 3 years. That made me feel a bit embarrassed and like I was behind everyone else my age. So in this video, I'm gonna break down the exact investing plan that's grown my net worth month by month without having to time the market. I'll break down how I allocate my money, how I automate my investments, and how I think about building wealth over the long term while living in an expensive city like New York. It's the same plan that I would recommend to anyone who wants financial peace instead of financial anxiety. Let's get into it. All right, let's start by zooming out and setting the scene for how the system will look. And I'm a sports guy, so I'm gonna use football as an analogy. And by football, I mean American football. So there are gonna be 3 systems: your offense, your defense, and your special teams. Defense is where you focus on protecting your money and protecting against emergencies. Offense is where you focus on making money and growing your wealth. And special teams is where you focus on potential. So you're setting yourself up to potentially make a big play, but you're not relying on it to win you the game. So first, you focus on building your defense. Before anything else, you need to protect yourself. If you follow football, you know that the classic saying is that defense wins championships. And when you're in your 30s, you know that it feels like life is always trying to score on you. So your first goal isn't to make money, it's to not lose money when life happens. So step 1 is gonna be opening up a high yield savings account and building up 6 to 9 months of living expenses. Most people would probably refer to this as an emergency fund, but make no mistake, this is your financial defense. It may or may not seem like it now, but life is going to try and score on you. You could lose a job, your rent could go up, you can get medical bills, so you wanna make sure that your defense has you covered. It protects you from having to sell your wealth building investments every time you're in a pinch. Emergency funds aren't sexy, but they're the main thing that's gonna help make sure that your financial plan doesn't collapse. So now that your defense is set, let's talk about building your offense. This is where we start including investing into your system. Now, the single most powerful wealth building tool that you can do in your 30s is automation. If you take away anything from this video, I hope it's that automation is the key to building long-term wealth. You're gonna wanna treat investing just like any other monthly expense, like it's Netflix, your electric bill, or rent. Every month, money is gonna automatically move from your checking account into your investment accounts. You're gonna set it up and then just forget about it. So first thing you're gonna have to do is pick a brokerage account. I use 2. I use Vanguard for most of my investing, and then I also use Robinhood for some other investments. Next, after making your account, you're gonna have to link your checking account to your brokerage account. From there, you'll be able to set up a recurring transfer from your checking account into your brokerage account. Now, a lot of people make the mistake of stopping here, but your money isn't invested yet. Basically, all you've done is you've set up a transfer from where instead of your money sitting idle in your checking account, it's now sitting idle in your brokerage account. When you transfer money into your brokerage, it sits in something called a settlement fund or a settlement account. And think of it as like a checking account, but within your brokerage. And this money is not invested yet. It's just sitting there idle, the same way it would be sitting idle in your checking account. So we still need to tell it where to go and where to invest that money. So when you create this recurring transfer, you're gonna have to decide what number is right for you. So you can do $100 a month, $500 a month, $1,000 a month. It's gonna be different for everyone depending on your financial situation. What this is doing is simply getting you in the habit of dedicating money every single month for investing. Automation is gonna turn investing from a decision into a habit. So once your system is automated, the nice thing is that your wealth is gonna compound and grow in the background while you just focus on living your life. And if you're having a hard time deciding how much money you wanna dedicate to this recurring transfer of investing money every single month, a good rule of thumb is 20% of your income should go towards investing. So let's say you bring home $4,000 a month after taxes, $800 a month would be going towards this investing plan. Now that you've decided how much money you're gonna invest every single month, and now that you have your brokerage account set up, we now need to allocate that money into investments. Because remember, right now it's just sitting idle in your brokerage account. The first place that you wanna put your money is in tax-advantaged accounts. Examples of tax-advantaged accounts are 401ks, Roth IRAs, and traditional IRAs. These accounts allow your money to grow tax-free or tax-deferred. When you're in your 30s, you're in your prime earning years, and so every dollar that you can protect from taxes now will help you exponentially in the future. 401ks are typically contributed through your employer, And so if you have that set up, you're already doing better than most people. So for this video, let's focus on Roth IRAs and traditional IRAs. They sound similar, but they work pretty differently. The main difference is when you get taxed. A traditional IRA gives you a tax break today, so you contribute pre-tax dollars, which lowers your taxable income. But when you retire, you pay taxes on every single dollar that you withdraw. The traditional IRA also allows you to deduct any contributions from your taxes. So for example, if you contribute $7,000 to a traditional IRA and you're in a 30% tax bracket, that gives you about $2,100 in savings this year. But like I said, there is a trade-off. And so when you retire and you start withdrawing from your traditional IRA, those withdrawals are seen as taxable income, and so you'll have to pay taxes on it then. A Roth IRA is the opposite. So you're gonna contribute money that you've already paid taxes on now into the Roth IRA and invest it. So in the future, when you withdraw, there's no taxes on it. So unfortunately, with the Roth IRA, you don't really get any tax savings now. You're deferring the tax savings to the future. And when it comes to IRAs, both traditional and Roth IRAs, there are contribution limits. So right now, at the time of recording this video, you can only contribute $7,000 to a Roth IRA or a traditional IRA, and that's combined. So it's not like you can contribute $7,000 to one and open up another one and contribute another $7,000. It's $7,000 per year to both of the accounts. Technically, you can invest more than $7,000 in the traditional IRA and the Roth IRA, but you only get tax benefits up to $7,000. And personally, as someone that's in their 30s, here's how I would think about picking between a traditional IRA and a Roth IRA. And again, this is not investing advice. This is just my personal opinion based on my situation. If you expect to be earning more later in your career or later in your life, I think that starting the Roth IRA now is probably a better long-term play. You're basically locking in your tax rate today and avoiding paying a higher tax rate in the future. So even though you pay taxes on this money up front and it hurts a little bit now, I think that the tax-free income that you'll get in the future is super valuable. And that's why I personally max out my Roth IRA every single year at the full $7,000, because all the growth and the withdrawals when I'm in retirement are gonna be tax-free. Another benefit of the Roth IRA, in my opinion, is flexibility. So you can actually withdraw any of your contributions that you've made to your Roth IRA at any time without penalty. But just to be clear, you cannot withdraw any gains that you've made within your Roth IRA without penalty, only contributions that you've made. So for example, if you've contributed $30,000 to your Roth IRA and that money has grown to $50,000, you can withdraw $30,000 penalty-free, but that extra $20K that you've made in gains, if you decide to withdraw any of that for any particular reason, you will have to pay taxes and penalties on withdrawing early. I'll do a deeper dive on both of these accounts and other retirement accounts in future videos, but right now this is really all you need to get started. So just to recap, your first step is going to be setting up recurring transfers from your checking account into your brokerage account. Next is logging into your brokerage account and following the prompts to open up either a traditional IRA or a Roth IRA. And again, your money isn't invested yet, it's sitting idle in your account. So next we're going to talk about allocating your money into particular investments. One of the keys to building wealth over a long period of time is to forget about beating the market. The top traders in the world earn millions and millions of dollars, and they spend all their time researching stocks and researching markets, and they don't even beat the market most of the time. And so it's time for you to be humble and understand that you're probably not going to beat the market. So what do? Instead of trying to predict who the big winners are going to be within the market, basically you're just going to own the entire market. An index fund is a fund that passively tracks a group of companies. It owns everything within a specific market, so it gives you instant diversification across hundreds of companies. So for example, an S&P 500 index fund owns shares of 500 of the largest companies in the US stock market. So when those companies grow, your investment grows with them. This is called passive management. Now let's compare those to actively managed funds. These funds basically have someone or a team who buy and sell stocks within the fund and try to get you the best return. One area that often gets overlooked by investors are fees. Every fund has something called an expense ratio. And so when you hear the term low-cost index fund, the low cost is referring to the fund having a low expense ratio. An expense ratio is the annual fee that you pay to own the fund. Low-cost index funds usually charge anywhere from 0.03% to 0.1% per year. Actively managed funds often charge 1% or more. And that percent difference may not sound like much, but over the course of 30 years, let's say, that could be the difference between hundreds of thousands of dollars. And so those low fees are another reason why index funds really do win over the long term. Personally, at the time of recording this, I keep around 70% of my portfolio in low-cost index funds. They're the engine that drives my entire long-term investing plan. And to keep up with the football analogy, you could say that index funds are the identity of my offense. Another benefit of index funds is peace of mind. You can actually focus on enjoying your life while you're investing and and compounding happens quietly in the background. When you own the entire market, you're less likely to panic sell and you're less likely to get emotional when you see different headlines in the news. You stop checking prices every day and you're no longer just focused on one or two bets. You're really just focused on overall economic growth of the entire market. So now I'm going to share 3 index funds that you can use to get your portfolio started. They're also the 3 index funds that I personally invest into every single month. The first one is ticker symbol VTSAX. The second one is VIGAX. And the third one is VFIAX. VTSAX is a total US stock market index fund. This fund owns nearly every single public stock in the US. It has large companies, mid-sized companies, and small companies. This gives you instant diversification across the entire US economy. The expense ratio is extremely low. At the time of recording this video, it is 0.04%. So just to give you some context on what the expense ratio means, at 0.04%, that means you're paying about $4 per year for every $10,000 you have invested. VTSAX is kind of like my own everything fund. So VFIAX is an index fund that tracks the entire S&P 500. And like I said before, these are the 500 largest companies in the US. This includes companies like Apple, Google, Microsoft, all the big companies that you know. And VFIAX has a very low expense ratio as well. It's also around 0.04% at the time of filming this video. Historically, the S&P 500 is a great long-term investment. It grows steadily over time. And so until that proves to be no longer the case, it's going to be a core part of my portfolio. VIGAX is a growth index fund. This fund focuses on companies that are expected to grow faster than the rest of the overall market. Just so you know, growth companies tend to reinvest profits into growing the business, and so therefore they don't really pay a big dividend or anything like that. So these growth companies are going to be a little bit more volatile in the short term, but over the long term, you can expect that they bring you big returns. And VIGAX has a slightly higher expense ratio. Right now it's 0.05%, which is still pretty good. When you put these 3 funds together, they really do give you a good balance. So VTSAX or VTSAX is going to give you total market exposure. VFIAX, that's the S&P 500 one, is going to give you stability through large, reputable companies. And VIGAX is going to give you long-term growth potential. And when you look at the companies held by these funds, you're going to notice a lot of overlap. In my personal opinion, I don't mind the overlap. It's reinforcing my investments into quality companies. And so I don't mind that I'm invested into the same companies across the 3 different funds. And heads up, a lot of these index funds have startup minimums that may seem high. So for example, when you first try to buy an index fund, there might be a minimum investment of, let's say, $1,000. But after that initial $1,000 investment, going forward, you could put recurring payments of $100, $200, whatever you want into the fund. It's just that one first-time minimum requirement that you're going to have to hit. Now that your defense and your offense are set up, let's talk about your special teams. Now that your core financial defense and offense are set up, you can afford to take some big swings here. Think of this as like a long kickoff return for a touchdown or a block punt or even a lucky play that leads to a score. You would never rely on these things to win you the game, but it's nice to put yourself in the position where you could potentially make some big plays. Depending on your risk tolerance, I recommend dedicating a small portion of your portfolio towards higher upside investments. Personally, I dedicate 5 to 10% of my portfolio towards these type of investments. These are investments like individual stocks, cryptocurrency, collectibles, or even private investments like investing in your friend's coffee shop. So these are asymmetric moonshot type of bets that you're making here. And so because you're only dedicating a small portion of your portfolio to these accounts, there's small downside, but potentially large upside. The key rule here is to only invest as much as you feel comfortable losing. And when I say losing, I mean literally lose all of it. You have to be okay with that. So again, this is not investment advice, but personally, I am okay with the downside of potentially losing 5% of my portfolio. And that's because the potential large returns that these type of investments could bring are worth the risk in my opinion. So make sure you understand your temperament as an individual. If taking risks tend to make you nervous, invest less into these assets and more into the index funds that we talked about before. If you take one thing away from this video, let it be this: simple automation beats complex trading every single day of the week. You don't need to be a financial expert to build wealth. You just need a simple system that runs automatically. And if you're watching this thinking, man, I feel so behind, you're not. Sure, maybe the best time to start was 10 years ago, but the second best time to start is right now. So now that you have your investing plan set up and automated, you might want to learn more about the differences between index funds and ETFs, which I talk a lot about in this video.